Good morning, everyone. Today is Tuesday, the 27th of January, 2015. My name is Wayne McDonald, Chief FX Market Strategist for Traders Way. Today is your Forex Trader Strategies session. Today we got requests for Euro and Yen pairs, some commodities, specifically oil and the FTSE. Sure, sounds good to me. Trade it, huh? Okay, hopefully you can see four charts. Oh, Jim requests gold. Dan asked for oil. Harvey asked for FTSE. We can do all that. You guys got the four charts? Four USD charts? I'm going to take that as a yes. Thank you. All right. Let's do a quick trip around the world. British pound is neutral. Euro is neutral. Swiss franc has been very weak overnight, but is slight neutral. Yen was very strong, very weak, and is now neutral. US dollar neutral. Aussie dollar neutral. CAD more weak, and Kiwi neutral. So good time to be doing your technical analysis. If you attended the planning session yesterday, we had Chinese industrial production, we had Australian business confidence overnight, right? And we had some UK numbers coming out. No big surprises everywhere. The China numbers were not great. The UK numbers were not great. I think the Aussie numbers were slightly better, but no big differential between the expected and actual. And to get the market moving, you're going to need big differentials. So nothing crazy happening over the last 24 hours. Big event risk of the week is obviously the FOMC, and then there's GDP for USA and CAD on Friday. I'm just going off the top of my head here. So no major market move, which is fine. So let's trade conservatively and use primarily technical analysis. Okay, there's some good opportunities for some pullbacks. Okay, but here we are in the London Lunch New York Open session, and the market, generally speaking, is neutral. All right, so should you trade aggressively? Probably not. Okay, US dollar is essentially flat. So you have to decide what you want to do here. Is the dollar going to gain strength later in the day? Well, let's take a look at the pound dollar here on the left. Pound dollar is kind of trying to go up in the moment here. Euro dollar, let's change this to an hourly. It also looks like it's trying to go up. Change this to an hour. Okay, this one also looks like it wants to go up. Make sure this is on an hour. Make sure the periodicity is the same. This one's coming down. More talk out of Bank of Japan today about inflation targets being missed. And we already know that, so it shouldn't be a huge market mover. But sometimes it is. Not everybody's on the clue train. But, for example, why is the Bank of Japan going to miss their 2% inflation target? Why? Because oil's down. I mean, we're discussing this on all central banks right now. It's one of the major reasons, if not the reason, the ECB was forced to do quantitative easing. Remember, they for years refused to do it. Then oil dropped 70%, and then what? Draghi goes to the courts, asks for the power, gets the power, announces the QE, all in about 3 weeks. Something in the market forced his hand. Oil prices. So it's affecting everybody. If you're trying to create inflation, oil is a huge part of your inflation, right? So anyways, so headline inflation tanks and stuff like that. So it's affecting the Bank of Japan. And so when you get a statement like that, that's going to produce yen strength, at least on the short term, right? So nothing to be unbelievably concerned about. Those are pretty obvious trades. Now, looking at this, you have to decide, are you a bull or a bear? And if you're a bear, you need to start planning here because you're in the right area. And if you stick to your guns as far as your bias, if you're wrong and this keeps going up, you're probably not going to get a trade entry. Okay? You don't have to trade every move. Just because it's going up doesn't mean you have to buy it. You could be, if you were, let's say, bullish on the US dollar, bearish on the British pound, you could be setting this up for a short, even though it's been going up for a while, all this week. Notice how it reversed at last week's aggressive target area, right? The pivot points. Notice how it double bottomed at the weekly reversal pivots. Pretty interesting, I think, right? Higher, high, higher, low, 1, 2, 3 type pattern. Great. So how do you use pivots now? Well, if you think the downtrend is going to continue, okay, and let's go over the fundamentals of this part. 2 members of the Bank of England have changed their sentiment from the Bank of England needing to raise interest rates to neutral. So the Bank of England is less hawkish. Fact. Okay, we've learned that just in the last, week? It's been about a week now, I think. So, that could be possible. Why is the dollar weak? Well, we've been buying dollars fast and furiously since last October, right? And then the real move happened in the, the June ECB meeting? So anyways, it's been a big run, and the event risk is the FOMC meeting. Not a bad time to take profit and take a breather until that event occurs, right? Okay. So, anyways, I think it could be plausible that somebody wants to sell this. So I could adjust here these trade zones that we did a week ago. We can adjust these now to overlap with the pivots as I'm doing here. And this gives us 2 pivot-related trend trades. We're currently on the M3. The next one up is the R1. So let me show you how this is out. Let's just say today's high holds, even though we're testing it right this second. Let's just say it holds. That means this week's M3 could be the top. If M3 is the top, based on weekly pivot point theory, the target is 148.50. You got that? M3 to M1 pivot points. If this goes up a little higher, hits the next gray area, and tops out at the R1, then the target to the downside, if you're a bear, is 149. Just depends on where the top is. If you're a bull, you should have bought down here near the weekly. Okay, the break, the pullback, got. Okay? Stochastic divergence. Yeah, I suppose that it would create stochastic divergence, right? Thank you, YJ. If it went up and hit the R1, this is likely to be still low, showing weakness in the up move. Sure. For me, what I would do is if it went up to the R1, all it have to do is get into that zone. You know, let's just call it 5150. As soon as it got near that, I drop into a 5, take a cycle down. Okay? Because it's a pretty defined strategy. I know where the resistance is. Stop would just be on there, and I'd let it work itself out. Okay? Euro, let's take a look at what's going on here. What do you want to do with this, my friend? I think I talked about this yesterday with somebody. Hang on. You know when you spend your whole life on charts, just, they all look familiar after a while. Everything, you're like, yeah. But it's Tuesday, I've probably spent 40 hours in front of the charts. All right. That's a 1, 2, 3 pattern. You see what I'm drawing here? So based on the 1, 2, 3 pattern and the Stokes kicker, okay, right in here. Now let me zoom in. If you're going to counter trend trade this, look at this: Asia open, London open. Okay, somewhere in here, this little area, let me mark it. That didn't work. Insert shapes, ellipse, kiss my ellipse. All right, somewhere in here, that's the Asia fade. Somewhere between the Asian Open and the London Open, you would want to go long. Okay? Counter trend trade, you got the oscillator perfectly set up after a 1, 2, 3, which is let's mark those up with ellipses. Okay, here's a bottom, right? Fine, but the trend is down. No big deal. Makes a pull back into the roll reversal area. As a bear, that's exactly what you would expect, and that would be your short zone. Nothing complicated about that. But the issue is, if you were a bear and you sold there off the roll reversal, you would be thinking that it would make a lower low, right? That's the whole trade plan, right? So isn't it interesting, or isn't it important that it didn't make a lower low? And the answer to that question is yes, it is important. Okay? Makes a big significant pullback. It's a slight higher high. I've seen better higher highs, but let's just say it's more than a 786. Okay? So when you get that, the thing that you do immediately, because now you have a double bottom, which is a way to identify solid support, and a significant pullback, that's a change of trend. And then you fib it. And in this case, it made a 50% retracement from the reversal high to the double bottom, long and gone with a Stokes kicker pre-London. Okay. Now the problem is it's a counter-trend trade in my humble opinion, but technically you could set that up all day, every day with that strategy. And what you're trading, if you're right on this move, okay, is that change of trend from a series of lower lows and lower highs to consolidation to breakout, which is now a series of higher highs and higher lows. Does that make sense, everyone? That's just the technical plan on how to do a 1, 2, 3. Okay, that's a clear opportunity if that's what you're looking for. The thing is, you have to be looking for it, right? Where's the next level for shorting? Boy, oh boy, you know, I'm way out here trying to find it. I think that's a wick in there, isn't it? Okay. Well, let me zoom back in. So you would now take your fib. A bear would take the fib now this way. And measure swing high, swing low. And yeah, you could see this gray zone that I just drew on the higher time frame on the 4-hour fractal is essentially the 618 Fibonacci retracement. It's also 14.5. Yeah, so this could go up from, where are we now? 129, 129, sorry, 112.90. So we're at 113. This could go up another 150 pips and then we drop it. Seems like that could be tomorrow, FOMC day. Okay, so that puts you short-term long to long-term short. If you're going to trade it like a three-wave correction, then you're looking at this hourly oscillator, and you're thinking you're basically setting this up off of the the 3A2 to 50% area. You're using this area as resistance. You better use a psych level. So we're testing 13. So it's possible. Let me check this one. Yeah, it's definitely possible that you're setting this up actually for a short now. Okay, we don't have a lower low yet. It's a little aggressive. You notice that we're kicked off 15-minute high. I would use that as a roll reversal type thing. You can go back to this area. Okay, somebody bought it with a beautiful Stokes kicker. So bulls are definitely in this market, and we're still making a series of higher highs and higher lows. So it's a pretty aggressive trade. But if you're going to sell it pre-London, or how about this? If you're going to be aggressive to the downside, I don't disagree with you on direction based on fundamentals. Okay? It's the right time of day, pre-New York Open. And you're at a psych level, key psych level of 113. Okay? So is this vulnerable? Well, the 15-minute charts has, let's say, it's showing that we have probably at least a half an hour more to the upside, so there might be 2 or 3 more candles before it goes up, that it continues to go up, and then you drop into a 5-minute and you get ready to sell that. Or you start taking, if you're really aggressive and you're trading off the psych level, you start taking the 5 now and you have one. So what you're basically doing is saying this big move here that has occurred over the last couple of hours was the major test of resistance at 113-ish, right? 113XXXX. Significant decline. So you're going to treat it like a lower high, creating a 5-minute fractal lower low because you lowered than this low. That you're going to dump it on a 5-minute cycle, which is occurring right now. Okay, so let me mark this up with different colors. Kind of crimson, brown. What color should I use? Dark turquoise. All right. Okay. So an aggressive bear using time of day and a psych level to their advantage would be setting this up like this right here, right now. 5-minute cycle. Okay. It'll take a while to roll this over even on a 5-minute chart, which would roll this over very quickly. This 15-minute would jump up really quickly because the current candles would have difficulty of making higher highs, which would pull up the oscillator if you understand the math, which prepares the hourly. The hourly's already pointed down. The 4-hour wants to drop. So in my humble opinion, it's either going to drop here or it's going to drop at the higher up level. So if it doesn't drop at 13, it's going to drop probably at 1450. Debise asks, do I use MACD for divergence? Yeah, sure. They're just measuring different things, right? So the way I use MACD is to measure overbought and oversold conditions for the market, which is just absolutely fine. Okay, so divergence of market, it's just slower, and you're measuring something different. The oscillator, I'm using to measure price action. How many people here would like a very quick lesson on MACD? So like a real, not like a trading strategy per se, but actually know what it means. Because I find a lot of, they're like, oh, I got this great MACD trading strategy. Really? Tell me about the math. What does MACD tell you? Oh, I have no idea. Oh, but you have a good strategy, but you have no idea why it works. Good luck with that. Yeah? Sure. Well, let's do one. The reason you don't see MACD on these charts is I just see it. When I trade alone, I don't even use Fibonacci. I mean, I do use it. I don't draw it because I can just see it. MACD and stuff, I just see it. So let me explain it to you. In fact, when I've mentored or done, group training and stuff over the years, one of the things I've done is I've handed out blank charts. I mean, you got the price action, right? But you can't tell what currency pair it is. But you can see the candlesticks, right? And then underneath there's a blank area because I've deleted the MACD, right? And I hand them out to everybody and I say, draw the MACD. Have you guys ever thought about that? Do you think you could do that? If I just gave you candlesticks, right? So you can see all the price action and I say, draw out the MACD oscillator. And they're like, what? Yeah. You have all the information there, right? Draw the MACD. How many people think they could do that? And if you can't, say no. Come on, guys. And it's interesting. Hey, look, you're right. It's interesting because if you can do it, you understand the math going on. And if you understand the math, you understand what it's trying to tell you, and therefore it's not really complicated. Okay? So I should be able to give you this chart right here, right now, and you'd be able to draw the MACD. It's really easy if you know it. All right, so let's do a 5-minute overview of understanding the mathematics of the Moving Average Convergence Divergence Indicator. Okay. Now, like I said before, I use the MACD to measure overbought and oversold conditions for the marketplace. Okay? Not price action. So I have to separate the two. So you have to start with the basic definitions, right? So when I designed my use of MACD, and you got to remember, I'm self-taught. I've been doing this so long. There was, there wasn't much resources to learn. So I'm self-taught, right? So I looked at the market, and I look at price, and I separate them. And my definition of market is if somebody came up to me, and people used to do this all the time, right? They're like, hey, so how were the markets today? Right? They just want to know, did it go up or did it go down? They're not like, well, for 3 hours it was up, and then 2 hours it retraced, and then it consolidated, then it broke out. Like, that's not what they're asking, right? That would be more price action. They just want to know, hey, is it up or down? And I thought, well, that's actually a very astute question, because I need to discern whether I want to buy or sell. So I used the MACD to do this. And I also used moving averages. Okay, so in this chart, we're looking at an hourly chart. And I need something here to tell me the direction of the market, whether I should be a bull or a bear. So I spent a couple of years experimenting with various moving average combinations. Okay, and I use the 2155 EMAs to represent market. It's the orange line, the blue line. 21 EMA, 55 EMA. And together, they show me the direction for the market. So if the 21 is below the 55, the market is bearish. If 21 is above the 55, it's bullish. Okay, that's pretty easy, right? By the way, it makes me think we should do an advanced training. Like, I should do like a 2-hour or 4-hour event or something like that. What do you guys think? I'm thinking that we could just, I could spend the whole time just doing this. Today, I want to set up the trades too, but boy, we could really dive into this, right? Because I love explaining this stuff. It's amazing for so long, and I still love sharing. Yeah. All right. So anyways, the other thing that you can use the 2155 for, and trust me, this does have to do with MACD. If I don't explain this, you'll never understand. Okay. The other thing I'm looking at is the angle and separation. If you have a nice 45-degree angle, okay, then the market is aggressively bearish. And there should be nothing on this planet that would make you consider going long. Nothing. Okay? And the second thing that I look at for, right, is the separation. If they're widely apart, you're very, very aggressive. But if they're narrowing like they are here, the angle and separation is diminishing, the market is slowing down. Now, technically, you see how they're almost touching? I call that a 2155 kiss. The market is still technically bearish, but much, 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 much less bearish than it used to be. Okay? Here, unbelievably aggressively bearish. Then yesterday we broke through this, and I think I was talking about that if the 55 comes down, pushes it down, I would expect a double bottom. If it wasn't this pair, it was a different pair, but it's all the same. Okay? In this case, the 55 didn't even push it down. So technically, we're still bearish, but almost essentially neutral at this point. Okay? Because the distance between the 21 and 55 is almost nil. Okay? So here, technically, the market turns bearish. The market is aggressively bearish. All the way down to here, and down into here becomes a lot less bearish, and then where we are now is neutral. So I thought, you know what we need? We need an indicator to help us see these things, to measure the angle and separation between the 21 and 55 so I can see that information even more clearly. Does that make sense? Because I want to know, is the 21 and 55 moving closer together? And is the 21 above or below the 55? So you know what we need? It occurred to me, a moving average convergence divergence. I want to know if those moving averages are converging, which means getting closer, or diverging, meaning moving farther apart. Now I know when they're moving farther apart, when they're diverging, I should be aggressive. But if they're converging, I should be conservative. Doesn't that make sense? You're like, oh my gosh, well, that's why they call it a moving average convergent divergence. That's name. That's what a MACD does. So let's make a MACD. Insert, indicators, oscillators, moving average oscillator, MACD. There it is. MACD. All right. So what moving averages am I going to measure here to measure the overbought and oversold conditions for the market? What moving averages am I going to input here? Well, I want to measure the 21 and 55, right? The angle and separation between the 21 and 55. So in that case, I'm going, in the fast EMA, I'm going to put 21. In the slow EMA, I'm going to put 55. You're like, well, Wayne, why are you changing the default settings? Well, because I'm asking it to tell me the angle and separation between the 21 and 55. I could put whatever moving averages I want here. It's just going to measure the angle and separation between the 21 and 55. That's all. I'm asking it to do the calculations for me. How many periods do you want to look at? I like 8. Why? It's a Fibonacci number. I mean, who cares, right? So that's pretty much it. So let's add this. Boop. Okay. Here's the waterline. By the way, I actually use a different MACD. This one is the one that only has one line. Okay, but this is good enough for me for now. Okay, so let me explain this here. Let's move this up even more. All right, so there's the MACD. So you can see that they're drawing one of the lines with a histogram, the other one with an actual dotted line. So there's a few things going on here. Okay? The first one is the water line. When price drops below the water line, the 21 has crossed below the 55. If you see how we get two little bars that pop up for just a little tickle, the 21 was above the 55 and then immediately dropped below the 55. So I can look at this immediately and see here that the 21 was above the 55. This is where they were crossing, and now the 21 is below the 55. I see that immediately. That's what this is telling me. So the first way to use the 2155 is to simply answer the question, am I bullish or bearish? Or the actual question, is the market bullish or bearish? Okay, remember? Now the second one is the angle and separation. Are they converging or are they diverging? Okay? When the lines are pointing up and they're moving back toward the water line, they're converging. When they're moving away from the water line, they're diverging. So aggressively bearish, conservatively bearish, aggressively bearish, more and more conservatively, conservative, okay, but still technically bearish. So now if this rolled over and started heading down again, once again, the market would technically be more aggressively bearish. If this continues and it heads above the 21, or sorry, above the water line, it tells me the 21 is now above the 55, and the market is technically bullish. So do you guys understand the two things it's telling you? Has there been a 2155 crossover? That tells you direction. And the other one measures, okay, whether, I guess the quality, right? So here I'm aggressively bearish, conservatively bearish, aggressively bearish. And you can see here a long time ago, the market was still bearish, but it told you in here to be conservative. Okay, in fact, let's just get rid of this, Stokes. Okay, Stokes is gone. So right here, you see this? Let me make this a bigger line. Hang on. That's where it crossed over, started heading back toward the water line. 21 is still below the 55. Okay, but the distance between the 21 and 55 is converging. Okay, so you take this up now, and I'll extend the vertical line from that point. And right there is when the market was already becoming less bearish. Okay, let's do another one. Okay, this is where the market turned bearish again, aggressively bearish, not just technically bearish, but aggressively bearish, right in here as it breaking out and making a lower low. Okay, so on and so forth. When did the 21 cross below the 55? Okay, the first time was here, then it kind of consolidated and then technically there, right? So let's go back to this point. The market turned bearish there. Okay, consolidated, then boom, short. Okay, that's what the MACD is telling me. So whatever the default settings are, just make sure you want to use those moving averages. Okay, breakout, pullback, sell. And you can do this on all time frames, 15 minutes and above. After a while, if you drop into the 5 minute, things like, there's no market in a 5 minute chart, right? So you wouldn't measure it there, but I would use price action like a stochastics. Okay, so now I should honestly be able to give you a chart like this where I change the properties here. I go white, white. Okay, delete. I deleted the whole thing. Let's just get very quickly. Insert indicators, oscillators, MACD. All right, white, boom. I should be able to give you this chart now. I can tell you this is the water line. Okay. And I should be able to say draw the MACD, and you should have no problems doing it. You need to understand what your indicators are telling you, guys. Otherwise, it's just a leap of faith. Just reading an ebook you bought on eBay somewhere for $1 and make $1 million trading Forex is just stupid. Okay? You need to understand what the algorithms are telling you. They're tools. Okay? They're not a holy grail. The more that you understand the tools that you use, the more that you can become a master of your domain. Okay? And so two things that I would look at if I were me would be the MACD, which I hope you understand, and also I like to use stochastics. Why do I like to use stochastics? Because it measures overbought and oversold conditions for price action. Because it occurred to me, 10 or 12 years ago, that I need to separate market forces from price action, because somebody can ask you, hey Wayne, how are the markets today? I could say two things, right? Oh, well, it was up, it was down, it was up, it was down, it was up, it was down. But that's not what they asked me. I could say, well, generally, it was down today. We closed lower than we started. But I know that there were times when prices were actually going up, but generally speaking, it's still a down market. So, wow, there's price and market. There's two different things going on. And if I can align up my price action with the market forces, they would be congruent and aligned. I should probably start measuring these things. And that's where I was 12 years ago, teaching myself how to trade Forex. And it was a good thing to do. And therefore, I started looking at the tools that I could use to measure things like price action, market forces. And so therefore, that's why I use stochastics for price action and MACD for market forces, and then align them up. Okay? The next trick is fractal geometry. Okay? So that took a lot of time, so let's move over to the ends. Well, you know what? Let's just move over to, I promised to do oil and stuff as well. Okay, let's do gold. By the way, I hope that was helpful, guys. I'm doing my best to help you. I want you to understand. Okay, gold came up to 13, wimped out. Looks like it's made a lower low. So I would measure it like this. Okay. So it seems to me we're in a downtrend. Can you draw the MACD? Look, we're above the water line. Okay. See? Not a problem. You could easily draw the MACD. It's basically just slightly above the water line, and it's trying to diverge, but it's basically flat. Cool. All right, so I would still be a bear on this. I would look for resistance. We're still using the pivots. It looks like still respecting the pivots. Okay. But seems, currently flat to bear. So if you're going to sell it high. The higher the better. To me, it kind of feels like it's moving sideways here. So, 85, 75 until FOMC. Let's move over to oil. Okay. This was a long run coming, right? What, 3 weeks ago now? We sold it at 49 with two targets. One was at 44 and the other one was 42.50. It came down to 44, stopped and reversed, consolidated, and we're back down to 44. Target, I guess, is still 42.5. Why not? Hopefully now this old support area becomes resistance and we stay below 47. Okay? Make sense? Looks like we're still on mission with oil. S&P 500. Wah, wah, wah. Okay? Lots going on in here. So the question is, are you going to buy at the bottom? Well, on this hourly chart, it's oversold. These blue lines are here based on price action support. If I zoom in, we're near the gap, the low for the week. Might be an opportunity to buy if you're a bull on the US stock market. Down in here near 2034. Okay, let me change the color of these things back to red. Oops. Oh, I'll just do it. Okay. If you're a bear, could you sell here? Only if you lack discipline. Okay, because you sell high. There's nothing high about this. Okay. Next, somebody asked me about the FTSE. Let's take a look. Let's go to the hourly chart. Kind of feels like a head and shoulders setting up, doesn't it? What do you think of that? Let's take this out to a 4-hour. Yeah. Well, if it's going to head up, it's to do it soon, doesn't it? Where's the next one? Insert, shapes, rectangle. I'm wondering if it's this area here. I think so. Let's zoom back in on the hourly. Yeah, makes sense. So neckline off of that old swing high. What used to be resistance is now support. And then potentially, based on technical analysis, if this makes 100% retracement, it's certainly not an uptrend. So it would come up, it would 50% Fibonacci kick off of the midpoint cycle, and this old resistance becomes old resistance, and then it drops down to the next level. Then you measure the distance between the top of the crown and the neckline, and you expand that out to here, which is the target, and it also happens to be the next level support. So it would play out like this. Okay? And this would go like this. Then it would go like this. And then this would go like this, and then like this. Yeah, I hope you don't mind me drawing the stochastic oscillator for you as well. And wow, it's been almost an hour. I'd like to keep going, but we'll have to save something for tomorrow, huh? So again, I hope these sessions are helpful. I hope you're learning technical and fundamental analysis, but really just sort of like trader psychology, having a daily routine of going through your charts, setting up your trades, aligning your satellites technically and fundamentally, staying focused, but also enjoying what you do as a professional currency trader or someone that's on the path of becoming a professional Forex trader. So I hope you stick with me and that you show up every single day. And of course, Trader's Way is the one that's put all of this together for you. They care about you. They want you to succeed. They want you to fund an account with real money and trade successfully, not just for a few days or a couple of weeks, for months and years and decades and, you know, maybe even centuries as a currency trader. But you want to be on team with somebody that cares about you. So I think that's a good sign. So thank you to you. I'll see you tomorrow. Yep. Peace on earth. May the pips be with you. May your profits be above average. Again, my name is Wayne McDonald, Chief FX Market Strategist for Trader's Way. We do these sessions every day at the London lunch, which is 7:30 in the morning, Eastern time, New York time. Cheers.